Picture this: you have a credit card with a $5,000 limit, and this month you put $2,000 on it for a major household purchase. This is not reckless spending. The money is already sitting in your bank account, you know you're going to pay it off, and the moment your statement shows up, you open the app and pay the entire balance immediately. No late payment, no revolving debt, no interest charges. By normal logic, you are exactly the kind of customer the financial system should reward: disciplined, responsible, and smart enough to use credit as a tool. And yet, just a few days later, your phone buzzes with a frustrating alert: your credit score has dropped. That is the moment a lot of people feel something stronger than confusion. They feel cheated. The first reaction is almost always the same. Wait, what did I do wrong? You paid it off. You paid on time. You did not even let the system make a single dollar of interest off you. So why did your score still go down? Why are you behaving like a responsible borrower while the algorithm is suddenly treating you like you have become riskier? And here is the most important part. In many cases, you did not do anything wrong at all. The issue is not whether you paid your debt. The issue is when the system sees you. Most people assume a credit score reflects their financial behavior in real time. But that is not how this game works. The system does not see the exact moment you hit the payment button. It only sees a snapshot of your data taken at a very specific point in time. And if that snapshot catches you on the worst-looking day of your month, you can still be scored lower, even when in reality you are doing everything right. In this video, we are going to break down how the credit scoring system really works, why your payment due date is not always the most important date, and how to optimize your credit score without paying a single extra dollar in interest. The first thing we need to break is a very common belief: paying on time is enough. It sounds reasonable, and it is probably the most familiar piece of financial advice people hear, but it is only true for half the game. If your goal is to avoid interest, avoid late fees, and keep your payment history clean, then the due date really is the most important date. But if your goal is to optimize your credit score, especially in the short term, then the due date is not the date that decides everything. The date that actually affects how you appear on your credit report is often the statement closing date. This is where you have to separate two different games that most people accidentally lump together as one. The first is the cash game you pay before the due date to avoid interest and fees. The second is the data game: you control the balance that appears on the statement closing date to optimize your credit profile. These two games are connected, but they are not the same. You can play the first one very well and still make yourself look worse in the second one. In other words, you can be completely right financially and still look worse on your credit report simply because of bad timing. That is because a credit score does not track you in real time. This is where most people get it wrong. We tend to imagine the system is watching our finances like a live camera. Feed you swipe your card today, you make a payment tomorrow, so the bureau should know the next day that you no longer owe anything. But that is not how it works. The system is not watching a live stream. It receives data in snapshots. Banks do not continuously send every small balance change to Experian, TransUnion, or Equifax. What usually gets sent is the balance at one specific point in the cycle, and that point is often the statement closing date. So, if you use a large portion of your credit during the month and then wait until the bill shows up to pay it off in full, you may avoid interest and still leave behind an ugly snapshot on your credit report. Let's use a very concrete example. Suppose your billing cycle runs from the 1st to the 30th. Throughout the month, you use your card for different expenses and your balance climbs to $3,000 on a card with a $5,000 limit. The money is still sitting in your bank account, and you are fully able to pay it off. Then the 30th comes, the cycle ends, and the system generates your statement. On that statement, the balance shown is $3,000. That number is what usually gets reported to the bureaus. After that, you see that the due date is the 20th of the following month, and you pay the full amount on the 10th. From the perspective of your wallet, everything is fine. You are not charged interest, you are not late, and you are not carrying debt. But from the perspective of your credit score, the most important thing already happened before that. The snapshot was taken on the 30th, and in that snapshot, you were using 60% of your available credit. That is why so many people feel like they were punished unfairly. They look at the real situation and take responsibility. But a credit score does not read that full reality. It does not read the fact that you had cash ready. It does not read the fact that you intended to pay it all off. It definitely does not read the fact that you just finished making a payment 3 days ago. It only reads the number that was recorded at the reporting moment. If that number is high, the system reacts as if you are under more credit pressure, simply because it only reacts to the surface-level data. So the due date protects you from interest and fees, while the statement closing date protects you from being photographed on your worst-looking day of the month. One date helps you avoid losing money. The other helps you avoid losing points for no obvious reason. And that leads to the most important conclusion of this section: you are not being scored based on your actual behavior in the present. You are being scored based on data that was captured earlier. Once you understand that, your credit score stops feeling like an unpredictable mystery and starts looking like a system with clear rules. At this point, we get to the variable that can make your credit score jump up or drop down much faster than most people realize: credit utilization. Put simply, this is the ratio between the balance you are using and the total credit limit you have available. If you owe $500 on a card with a $1,000 limit, that card's utilization is 50%. If you have $10,000 in total credit across several cards and you are using $2,000, then your overall utilization is 20%. The math is very simple. It is just division. But this small-looking number carries enormous weight in how the system evaluates your level of risk. The reason utilization matters so much is not because it is complicated, but because it moves very quickly. Payment history takes years to build, and the age of your credit cannot change in just 1 month. But utilization is different. It is more like a short-term lever. If the reported balance changes, your score can change right along with it in the very next update cycle. That is why some people watch their score drop sharply after 1 month of heavier than usual spending, then bounce back fairly quickly once a lower balance gets reported the following month. But the system does not look at utilization in just one way. It looks at both your overall utilization and the utilization on each individual card. This is where a lot of people get careless. They think that if their total credit limit is high, then spending heavily on one card should not matter much. For example, if you have $50,000 in total available credit across all your cards and you are using $5,000, your overall utilization is only 10%, which looks great. But if one of those cards has a $1,000 limit and is sitting at $900, then that card alone is at 90% utilization. To the algorithm, that is not a minor detail. It is a warning signal. An account that is close to maxed out tends to look more like a sign of stress than a sign of control, even if you still have plenty of room overall. So when you think about utilization, you have to look at both layers at the same time. A strong credit profile is not just about having low overall utilization. It is also about making sure no single card is pushed into a range that makes the model feel like you are leaning too heavily on credit. This is also where the percentage thresholds start to matter. Once utilization goes above 30%, many scoring models begin to read that as a sign of more credit pressure than ideal. Once it goes above 50%, that signal becomes much stronger. It does not automatically make you a bad borrower, but it does make your profile look more like someone living close to the edge. And when you get close to 100%, meaning the card is nearly maxed out, the picture being reported looks very bad. And here is the sharpest point to keep in mind: the algorithm does not read good intentions. It does not know you have cash sitting in your bank account. It does not know you are simply concentrating spending on one card to earn rewards. It does not know you plan to pay the whole thing off next week. All it sees are the numbers: your current balance, your current limit, and the ratio being reported. From those numbers, it estimates the probability of risk. One person might be using 70% of their credit limit because they just booked flights for the whole family and will pay it off in a few days. Another person might be using 70% because they are genuinely strapped for cash. To the model, at the moment that the report gets sent, both people are sending a very similar signal: high credit usage. But if you are starting to think the obvious answer is to push everything as low as possible, then we are about to get to the next important twist. Because in this game, lower is not always better, and in some cases even 0% is not necessarily the optimal number. And this is exactly the twist a lot of people never see coming. Once they understand that high utilization can drag a credit score down very quickly, the natural reaction for most people is to push everything to 0. It sounds perfectly logical if 30% does not look great and 10% looks better, then 0% must be perfect. But in the world of credit scores, the thing that sounds the most logical is not always the thing that is the most optimal. The reason is that a credit score is not just trying to figure out how much you owe, it is also trying to see how you manage credit when you actually use it. If your profile shows 0 on every card month after month, the model may read that as a sign that you barely use credit at all. And when you are not using it, the system has less data to evaluate how you handle it. It sounds a little counterintuitive, but in the eyes of the algorithm, someone who uses credit very lightly and manages it well can sometimes look better than someone who leaves no sign of usage on their report at all. That is why the real goal is not absolute 0. The real goal is smart reporting. You want the system to see two things at the same time: that you do use credit, but that you use it at a very low level and without any sign of stress. You do not want to look like someone clinging to their credit limit, but you also do not want to look like a ghost with no activity at all. That is why a lot of real-world data around high-scoring credit profiles suggests that the ideal utilization range is often not 0%, but a very low number, usually somewhere between 1% and 7%. That range is high enough for the report to show active credit use, but still low enough that it does not get read as risk. This is where a very memorable strategy comes in: AZEO, short for all 0 except 1. If you have multiple credit cards, instead of trying to push all of them to 0 before the statement closing date, you bring almost all of them down to 0 and leave just one card reporting a very small balance, maybe $10, $20, or around 1% of that card's limit. The result is that the system still sees credit activity, but the level of usage is almost negligible. This is also where a lot of people get confused, because they mix up two very different concepts: reported balance and carrying a balance. Reported balance is the amount that appears on your statement and gets sent to the bureaus when the cycle closes. Carrying a balance means keeping that debt past the payment due date and starting to get charged interest. Those two things are not the same. You can absolutely allow a small balance to be reported on your statement, then pay it off in full before the due date, and still avoid paying a single dollar in interest. This point matters a lot, because if you do not separate those two ideas clearly, the natural reaction is, if I leave a balance, doesn't that mean I'm carrying debt? Not necessarily. You are simply letting the system see a small balance at the reporting moment. As long as you pay that balance before the due date, you are not carrying debt in the sense that triggers interest charges. You are just managing how your data appears on your report. So the big twist here is this: the goal is not to force everything to 0 at all costs. The goal is to make your profile look the way the system likes it best: active but very low, in use but under no pressure, showing credit but showing no sign of dependency. And once you understand that, you start to see that optimizing a credit score is not a game of paying as much as possible. It is a game of reporting in a much smarter way. At this point, the most important question is no longer, how does the system work, but what do I need to do to make it see me in a better light? Understanding the mechanism only solves half the problem. The other half is turning that understanding into a process that is simple enough to follow and effective enough to create a real difference when you need a stronger credit score. The first step is to find the correct statement closing date for each of your cards. Do not just look at the due date, because the due date only tells you when you need to pay in order to avoid interest and fees. What you actually need is the end of the billing cycle, which is the day the system takes the snapshot of data that will go on to your credit report. With some banks, this information is easy to find right in the app, but many of them highlight the due date while the statement closing date is buried in the PDF statement or the billing cycle details section. Open a recent statement and write that date down. The second step is to set a reminder 2 to 4 days before that date. Not on the exact closing date, but a little earlier, to give yourself a safe buffer. The reason is simple payments are not always reflected immediately. Some transactions show as pending before they officially post. If your statement closing date is the 15th, set the reminder for the 12th or 13th. That buffer gives you time to check your balance and make sure the payment has actually been reflected before the statement closes. The third step is deciding what balance you want reported. If you are preparing for a major application like a mortgage or an auto loan, You may want to aim for a very low range, usually around 1% to 7%. If you do not need to optimize things to the extreme, a very solid rule is to keep your reported balance under 10%. And if your goal is simply to avoid a major score drop after a month of heavier spending, then remember the most important threshold: do not let your reported utilization go above 30%. The fourth step is to make your payment before the statement closing date instead of waiting for the bill to come out. Let's say today is your reminder day, and your current balance is $820 on a card with a $2,000 limit. If your goal is for the statement to show only about $20, then you would make an $800 payment right now. When the closing date arrives, the statement will be generated with only a very small remaining balance. The spending in real life may be exactly the same, but two completely different snapshots can end up being sent into the system. The fifth step is to let the statement generate with the number you intentionally set up. Once the billing cycle ends, the new statement is created, and the balance on that statement is the number most likely to be reported to the Bureau. If you paid it down in advance, the picture that goes out will look much better. If you did not, then all your good intentions are still just intentions. The system does not score intentions. It scores data with a timestamp on it. The sixth step is to pay off the remaining balance before the due date so no interest gets charged. If the statement shows $20 or $50, you can still pay that entire amount before the due date and avoid paying a single dollar in interest. This is where you need to draw a very clear line between the reported balance and carrying a balance. The reported balance is the number that appears on your statement and goes onto your report. Carrying a balance means keeping debt past the due date and starting to pay interest on it. Having a balance on your report does not mean you are carrying debt. At this point, a lot of people ask about autopay. The answer is that autopay is useful, but it does not do the entire job for you. Autopay is great for protecting you from forgetting a payment, and it is helpful if you have it set to pay the full statement balance, but it mainly helps you win the first game, which is avoiding interest and fees. It does not always help you win the second game, which is optimizing the snapshot. That said, do not turn this strategy into an obsession. Tight optimization makes sense when you are about to apply for a mortgage finance, a car refinance, or submit a major financial application where a few credit score points could affect your interest rate or approval odds. The rest of the time, you usually just need to keep your utilization low, avoid pushing any card too high, and continue paying in full and on time. Think of this strategy as a lever you pull when you need it, not as a stressful way of living. And this is exactly where a lot of people damage their own credit score without even realizing it. The first mistake is focusing only on the due date and assuming that it is the only date that matters. The due date absolutely helps you avoid interest and fees, but it is not the only date that determines how you show up on your credit report. The second mistake is trusting autopay too much. Autopay is great for making sure you do not forget a payment, but if you hand over all control to it, you may accidentally let your statement close with an ugly balance and only pay it down afterward. The third mistake is thinking that waiting for the bill to arrive and then paying it in full is enough. For your wallet, that may be completely fine. But for your credit score, it is often already too late because the most important data snapshot has already been taken before you had a chance to clean it up. The fourth mistake is forcing every card to report absolute zero every single month as if that were the perfect end goal. We just saw why that is not always optimal. The system wants to see that you use credit, but that you use it very lightly and with a lot of control. The final mistake is panicking when your score drops temporarily. Utilization is a very sensitive variable, so your score can swing more than you think. 1 month of heavier spending can drag it down, but if the next cycle reports a better balance, it can recover quickly. Not every score drop is a disaster. Sometimes it is just the model reacting in the short term to an ugly snapshot. That said, understanding the rules does not mean abusing them. There is a line that if you cross, it can make the bank see you as a higher risk. One example is credit cycling, using almost your entire limit, paying it down mid-month, then charging it up again multiple times in the same billing cycle so that your actual spending far exceeds your official limit. On paper, you may think you are managing things well, but from the risk department's point of view, that can look very unusual. Another mistake is closing old cards you do not use. Every old card with an open credit limit is part of the denominator in your utilization formula. Closing those accounts can instantly reduce your total available credit, push your utilization higher, and make your profile look worse without you spending a single extra dollar. Over the long run, scoring models are not standing still either. Some newer models are starting to look at usage trends over time, not just a single snapshot. That means timing strategies are still useful, but they cannot fully replace genuinely healthy credit behavior. And that leads to the biggest conclusion of this entire video. People who are smart with money do not just know how to pay off debt. They know how their data gets captured, how it gets reported, and how it gets interpreted.